Inside a glass-walled boardroom in Washington, D.C., geopolitical winds swirl as word leaks that Dr. Leona Murray, famed for her unflinching optimism about digital assets, has overtaken rivals to become the frontrunner for the next Federal Reserve chair. Traders across the globe scramble to pass her track record, and a whisper spreads, if the dollar tumbles violently, Bitcoin could explode upwards. Yet, hidden liquidity traps might catch investors unawares. If missteps are made in sequence, a cascading sell-off could erase today's euphoria. London, midnight. In the shadows of Canary Wharf, data scientists observe a curious dance among Ethereum's whales. Their bulk transfers of ETH ripple through the block explorers, not frantic dumping, but deliberate, perhaps coordinated rotation. In another corner of the market, XRP's ledger reveals a deeper ailment: ownership has become dangerously concentrated. Over half of XRP's circulating supply rests in a handful of opaque wallets, betraying the network's philosophy of decentralization, and priming it for instability should a whale decide to exit. A New York hedge fund's nerve center. Here, a bold move by Strategy, a major Bitcoin holder, plays out. Their emulation of Tether's foray into credit markets was meant to unlock liquidity, but instead, it fuels the short sellers. Hedge funds, sniffing vulnerability, unleash sophisticated shorting techniques, borrowing Bitcoin against Strategy's newly collateralized loans. The price teeters as each leveraged bet amplifies market fragility, and even as Bitcoin rebounds to $93,000, the ascent feels precarious, balancing atop new forms of risk. A fluorescent-lit co-working space in Singapore, filled with caffeine and tension. News breaks: AI agents have breached smart contract defenses for only $1.22, discovering and exploiting new, inexpensive vulnerabilities. Across the Pacific, American Bitcoin, a product tied to political sentiment, nosedives 50% even as the broader crypto market rallies. The supposed proxy for US political risk, once a darling, is revealed as brittle and easily manipulated. In Zurich, an analyst hunched over a mosaic of trading screens spots a decisive shift. Bitcoin price movements disengage from traditional exchange flows and now hinge entirely on an obscure institutional liquidity index. Retail traders, unaccustomed to this new order, struggle to adapt as the familiar markers are rendered moot, replaced by the enigmatic actions of large, shadowy players. A grey courthouse in the Cayman Islands erupts as a judge's ruling transforms the landscape. Foundations surge 70% overnight, but the fine print exposes a devastating liability: token holders, long thought untouchable, could now be personally on the hook. Panic spreads through encrypted chat channels, once hidden risks surface, and the pillars of the crypto world tremble anew. In the final sequence, the crypto fear and greed index flickers at extreme fear, 26, a numeric condensation of the global mood. Amidst the data flood, $3.17 trillion market cap, sky-high volumes, sectoral surges, the underlying narrative persists that in crypto's relentless pursuit of returns, risk is ever evolving, and every solution sows the seeds for its own undoing.